So I think we're very fortunate actually to have 4 people from 4 very different firms, different types of investment focus, but a great deal of experience in the industry, and having seen a number of cycles as well, which I think is particularly relevant given where we are. So the title today is Private Equity, and I've changed the order a little bit, Disruptive, Nimble, Opportunistic, with a question mark. The reason for the question mark is that people always talk about private equity being disruptive. It's quite an overused term. I would question that a little bit, thinking about the fact that we've actually been around as an industry for about 50 years now. So how disruptive can you really be after 50 years? Also, are we really disruptive as investors, or are we just sort of kidding ourselves? Is there a danger that actually the traditional forms of private equity are no longer able to cope with the world around us? Are we being disrupted ourselves by technology, by new forms of investment? You know, you have crowdfunding at the venture end. You've got the big sovereign wealth funds, big pools of capital that are disrupting the big end of things. So, you know, how do we keep raising the bar and doing the things that we say we do on the tin, and justifying the sort of fees and carried interest that people are earning in our industry? So I'm going to start with Thomas, since you're sitting right next to me. Right. Thomas, can we really be disruptive as an industry?
I think when you look at disruption, you need to distill it down into pieces. Our strength is our governance. And our governance is not where you have a board that's not armed to make decisions. They are armed to make decisions. And at that board, the owners sit, and we can act pretty quickly. If you compare it to companies in the public setting where the boards are paid to avoid risks and they're not taking the risks they should, I think they're fairly poorly equipped to head on in the future that is changing and disruptive. So I think, long answer to say, our governance will not be disrupted. However, some of us are being disrupted as we speak, because the old model of leverage and incentives doesn't work anymore. It's not enough. And you can see that now I think we have 2,000 operating partners in our industry. We had 0 20 years ago. So we need to up our game too, and the ones in our industry that do not up their game, they will be disrupted and actually outcompeted.
And actually, it's interesting you say that. I saw an article in one of the industry papers yesterday, which was from an academic from Warwick Business School, and his word was, private equity is now spent force. You know, time for the next ownership model. So I think you know, some of what you're saying, unless we keep doing things we're doing, unless we keep moving things forward, we will be a spent force. Stephen, your views on that?
Well, as you said, I think disruption is an overused term and maybe isn't even applicable to what our core business is. To me, our job as private equity investors is to capitalize on disruption that has taken place and has affected a company that either is divesting an asset or maybe the asset itself, and then also to anticipate what might take place with respect to the asset or the company that we're buying or investing in. And the reason for that is, especially the panelists sitting here, but a lot of our peers, by definition, we're buying fairly large, entrenched companies with customer bases and processes and systems and so forth. We're not venture capital investors. We're buying more mature assets. And as a result, because of their maturity, they're always going to be exposed, especially in our fast-paced world where technological evolution and innovation is increasingly affecting existing business models. They're always going to be exposed to that. And so I think our job as investors is to anticipate the disruption, to encourage management teams to try to take actions in that anticipation, rather than being disruptive investors ourselves.
So it's more about sort of harnessing the disruptors out there, whether it's in the portfolio companies or whether it's the operating partners that we bring into the businesses. Cathrin, you had a good example actually when we were talking about this, I think from the healthcare side of things, about how we can be more disruptive with...
Yeah, I think that healthcare is one of the sort of last frontiers to be disrupted to some extent. I think the next 10 to 15 years in healthcare, we're going to see some of the similar trends of pace of change as you've seen in technology over the last 20 years. I think from a private equity standpoint, there's sort of two aspects that I see. One is that the disruption that you're starting to see going on, particularly in the payer and provider system, is actually putting pressure on large companies that actually are forcing them to actually change their business model. And out of that presents opportunities for us to look at carving out businesses that might have been underperforming or carving out businesses that are no longer to their core. I think the second part of it is, how do we keep them ahead of that changing business model? And so recently, a carve-out that we've just done, where we're putting in a kind of new executive team around the business, one of the first key hires that we're making after the CEO and CFO is actually for the Chief Information Officer, which, if you'd asked me even 5 years ago, wouldn't have been on our shortlist. And this person is an executive team leader, is actually front of house, is really going to be one of the people that's going to be involved in the architecture and that demand generation, because our world is moving very quickly away from an old-fashioned model that actually is about reps on the ground with their bags going around the doctors, to continuous medical education, making sure that the actual consumer, patient, and also the physician is informed. So having that information at the front end of our business model, having both the drivers and the KPIs that we need, as well as that demand generation fully integrated, is actually a key part of that solution.
I want to pick up on the digitalization point, actually. It's an interesting one, and I think that not every firm, not every group in the room, maybe is able to put, the sort of resources that you can put, into these sorts of businesses. But having a sort of chief digitalization officer is now quite a common post that you see in many of the GPs that we back. Gabriel, maybe some of your views, because you're really at the front end, speaking to some of the, very innovative businesses. What are sort of the general trends that you see, and what can you really bring to bear? How can you help those disruptors do better?
Yeah, I actually take a step back, and I might be naive. I think we're still disruptive as a form of financing. If you look at our entire organization, we only do growth investing. Our entire organization is geared towards finding companies that don't need financing and convincing them that they should take our capital because we can help them with the digitization and the next step in the evolution of their business models. And what we're seeing now is whatever your business model has been traditionally, it's being attacked in some shape or form by digitization, and whether that's the trends you see in the newspaper. I can't think of a day you don't pick up a newspaper today and you don't hear about Amazon going after some new vertical. I mean, they went after, I think this morning it was about them going after the healthcare industry, and then we're seeing media being disrupted, and we're seeing, and so I think it's one of the areas we now focus almost, probably about half of our time, is how we work with our portfolio companies to get the right talent, the right people, and the right strategy, not just to be to have the defense against digitization, but to be the aggressor, right? To how do you steal significant market share by using this as a trend?
Well, I'd like to pick up again on that sort of, we can be disruptive. We can be disruptive, but going really over to the nimbleness point, can you both be disruptive and nimble when you're so large? I mean, everybody on this panel is managing, very large pools of capital, been around for a long time. How do you harness the sort of entrepreneurialism at the front end, when you're trying to find the businesses, you're trying to be innovative, you're really helping those deal makers do something different, but at the same time have the quality control right across the whole organization, and to bring everything together. Maybe Cathrin, I'll go to you. CVC has a slightly different model, I would say, in the way that you give that sort of liberty to the people at the front end.
Yeah, we do. I think two things. That as a private equity industry, we now think we've become very big, and collectively overall we have, but still very many of the businesses themselves are actually pretty lean as organizations. So when we classify ourselves as being very large with about 110 professionals on the private equity side, that compared to the likes of a JP Morgan with 250,000 people, which is where I came from most recently, is a completely different order in terms of complexity and management and therefore nimbleness. So I think as an industry, we are still very small. The challenge for us is certainly how do we maintain that agility as we scale. And I think the very nature of the models that we have, which basically disseminates accountability and responsibility for our portfolio companies and that alignment of interest with the teams, with their portfolios, is absolutely key. Typically, we maintain a very small portfolio, each of us, 3 to 5 investments typically over the lifetime of that fund. You have an intimate relationship with the company and the management, so you're very closely involved in it. We have quite an interesting model as well, which I think is both a sort of positive incentive in terms of the allocation of upside, but also a negative equity component of it. So you have that kind of cuff and collar in place to maintain that sort of discipline to some extent through the cycle. So right now, when there's a substantial amount of leverage available to us to take, as an investor, you're sitting there cautiously assessing whether or not, if we hit a downturn, do we actually have sufficient buffer in there in place to actually manage that level of equity, level of debt to equity ratio too. So I think that's an interesting way of actually disseminating that sort of that quality control into the deal teams themselves.
So I think you talked about the concept of sort of negative carry, which is an interesting one, where you've got your personal balance sheets. I think the challenge maybe is to take all those learnings that you've got at the individual deal doer level and translate that back to the entire organization, so that you're nimble on the front end, but you're bringing all that, all the learnings back to sort of the mothership and then disseminating it. Thomas, you're nodding.
No, exactly, and I think we all have this debate, all of us. How do you create, or still maintain entrepreneurship, but still create order? Entrepreneurship can be also a very nice justification for sloppiness, because I was entrepreneurial, but you messed up. Well, I thought out of the box. That's all very interesting. So we have actually, I phrased the word here just 2 months ago, systematic agility. Agility very popular, as you know, and systematic is maybe not as popular. But to become systematically agile, you need to be able to test, but you also need to be able to measure. If you need to measure, you need data. So that's why we have actually now, I'm overwhelmed by millennials. We have a venture fund, fairly recently started. I have a lot of CTO of Spotify, people from Klarna, King, all those folks around me, because we need to start to measure. So when the entrepreneurs are out there testing stuff, we can back them up with data to enhance the level of data before they make the decisions, and we should learn from our mistakes. I think that the leader is the one that can retain the entrepreneurship, but make the entrepreneurs wise of not doing the same mistake again. So this is top of my mind every day of the week. How do you create EQT become systematically agile? And you do that by data and people.
And people. And I think CVC and EQT, you both have sort of separate funds for technology that they're, in a sense, they're sort of ring-fenced. But Gabriel, you're managing one big fund, aren't you? How do you do that right across the world? I mean, you're active in India all the way through to the US. How do you?
Yeah, hopefully we steal the best from CVC and the best from EQT.
In terms of people or ideas or both?
No, first I think what Cathrin said is the right nimbleness that we have in our industry is actually there are few decision makers, and it's very focused and concentrated, and I think that's something we never try to fall away from. What we've tried to do is, the nimbleness we've developed over time is we're a completely global fund, but a single fund, and we try to keep it as simple as possible, which is everyone invests out of the same pool of capital, everyone's incentivized on the same pool of capital. Everyone, as a result, is incentivized to share ideas and best practice across the same pool of capital, and that spans from China down to Brazil, the US, and Europe, so it's a really global platform. The really basic idea is, as we find great companies, we should all be incentivized to make them even better, and as we find great themes and great ideas and great areas for deal making, we should again be incentivized to do it better. I think the challenge is where Cathrin was pointing to is, as we grow, how do you create scalability? How do you make certain that you don't become an engine full of committees like a JP Morgan might be, but you continue to be focused on just generating great deals? And what we've done is we've just kept the partnership nimble.
And Stephen, I guess you've got a slightly different model. You can be very nimble even within the same fund, can't you?
We can historically, we have quite a few different vehicles, but our primary vehicle is actually a multi-asset class vehicle, so multi-strategy, so we can pivot between credit and equity. We're starting to move away from that, actually, and raise more dedicated funds. But I think the nimbleness in private equity is really a function of decision-making processes, organizational structures, and incentives, as well as sort of the structure of the kinds of businesses we're investing in or acquiring. So private equity firms, despite managing increasingly large pools of capital, tend to be very flat, very few layers. They're lightly regulated. There are relatively few decision makers who can make decisions quickly. The fact that you do have this sort of intimate relationship with only a few portfolio companies and with whom you're in constant contact, I think enables you to be a much more rapid decision maker. And so, and the incentive structure obviously is designed to drive you in that direction. I think the biggest inhibitor in my mind to the nimbleness of private equity is, in some cases, a capital structure will inhibit that, because you really, it creates a greater innovator's dilemma than an unleveraged business that might have the ability to invest more, or even sacrifice today's cash flow or profitability for the future. But absent that, I do think that private equity is nimble for structural reasons.
But it seems to me, I suppose, if you're talking relatively flat structures, sort of quite centralized decision making, quite tight incentive structures, trying to manage a matrix, managing a matrix with 100 or 150 people, not easy, but still manageable. Is it really scalable, actually? How big can the biggest private equity firm grow? Maybe Cathrin or Thomas.
We come back to organization again. We have 10 business lines. I don't know how many you have, but it's about division of authority. So if you, as you talk about delegation, the incentives are there, the decision power is there, the accountability is there. So therefore you can delegate a lot of the development. The development of our firm is created bottom up. Ideas generated within the business lines are steered through me, and then I can say, stop, that's best practice, now try to deploy it all over the place. So you cannot run a firm top down. You need to incentivize the people bottom up, but you need to steer them and control them. But they're authorized to take the decision, and they should take the decisions. And my job is to enable them with the weapons for them to be able to perform. So it's a bottom-up evolution. So if you have the governance right, actually, scale is not an issue.
Cathrin, maybe your view on that?
No, I would agree with that, and I think that nimbleness is about adapting to the environment that's changing around you too. So we have currently sort of 4 different asset classes that we manage, from the credit side through to the growth side, through to the main fund and the Strat Ops fund. We've also got, I think, an opportunity to continue to grow those sort of growth type funds, and we're going out to raise our new Strategic Ops fund again. And what I found quite interesting, having just made an investment out of the Strategic Ops fund, is that you can actually use the lens around the diligence on an opportunity and actually solve for it in a different way, to say, we think this business is incredibly interesting. We think over the long period it's got very interesting long-term growth rates. We don't know if that's going to come through in a 4, 5 or 6 year period. It might actually come through in an 8 to 10 year period, but we know that if we hold it for that period, given the cash generation of the business, but given the opportunities to expand it, we can actually see it through to that horizon. So I think there are opportunities to be creative around solving for really interesting businesses, really interesting business models with different vehicles that might be more over-equitized growth investments, longer term holds, or actually just the more traditional sort of private equity model.
I suppose what you're talking about actually is sort of growing the pie for private markets. I mean, we've done a little bit of research, which I mentioned on at least one of the panel calls, where you're looking at the public markets. Public markets have actually been shrinking over the past 20 years. And if you look at the number of publicly quoted companies in all the major developed economies, it's shrunk, in some cases by sort of 80%. And what's happening actually is a lot of companies are spending a lot of time private before they go public. So in the old days, an Amazon went public, and then the growth kind of happened afterwards. But nowadays, there's any number of examples. I'm sure, Gabriel, you've got some in your portfolio, where the companies are seeing all that growth before they become public. So are we actually shifting, part of the public market universe to private markets, where we're actually expanding our pie and taking more of the universe? Maybe you've got some views on that, Gabriel.
Without a doubt, and I think that's actually an exciting opportunity. And I think there are a couple trends that come behind this. The first is, God, is it dreadful to be a public company today, right? If you, as a growth business, right? If you see the way people react to just the most little hiccup, and as you imagine, when you're building a growth company, nothing goes in a straight line. It typically goes in diagonals. That's the first thing. I think the second thing is obviously it's become a lot less expensive to build a global business, right? So you're right. I think private markets have grown, private and public markets have shrunk. The other big difference is with $600 million, you now build a completely global business. That was not the case just 10, 15 years ago. So we view it as actually a risk and an opportunity. The opportunity is we're being called into great companies that would have been public 10 years ago, today choose not to. I think the flip side is it's taking away a pretty valuable tool in the ecosystem of financing, right? Which you go to the US today, no great company wants to be public. If Uber can choose to continue to raise $10 billion from the SoftBank, they'll do it. Why would they go public with the issues they have?
So that all sounds very positive, and I want to make sure we get to some of the, the negatives and the threats. So I think we ought to start talking about the, how opportunistic can private equity be, particularly in the face of major political and economic change. And we just heard from the previous discussion about what's going on in the US. We could expand that to Europe, to Asia. There's no shortage of problems out there. So how opportunistic can we be given geopolitical and economic realities? Stephen, I'm looking at you here.
Well, our investing style and philosophy is built on opportunism. And we all have our own DNA as firms and as investors. So even though we may wish we were something else, we sometimes aren't or can't be, we have almost all of our private equity investments have as the central thesis that we can improve the business that we're buying operationally. In many cases, significantly. We have a team of 125 operating executives full-time work for us, and we deploy them into these companies. And so our competitive differentiator is to find challenged businesses, or businesses at least that we think can be materially improved operationally. The problem is, especially after a long expansion and with a lot of capital, there's not that many of them. So we can't focus on a particular industry vertical, even though we would like to. And we have to be opportunistic because we have to be willing to pursue something very aggressively when we see something that fits into our aperture. So I think, opportunism has always been the hallmark of private equity, and I think particularly today, that's what really we are getting paid to do. And I think, my own crystal ball says that there'll be more opportunities in the near term for that kind of philosophy.
You're really talking about bottom up and looking for those sort of micro opportunities, but particularly with what we're going through today, does micro really still trump, sorry, not the public thing, trump macro, or is Trump going to trump us all? So does that model still hold, or are there such big threats out there that they're actually just going to sideswipe whole businesses? And I'm talking really on things that we really can't control. So maybe, I don't know who else has got a view on that one. Thomas?
I think we can all agree upon that a storm is coming. The question is when. And when it comes, two things will happen. Multiples will compress, and EBITDA will compress, particularly in certain industries. The first one we cannot shy away from. We're all going to get whacked. The second one, though, we do control. So in these times, we're always open for business. We have the mandate from you to deploy it, and we have to because nobody can guess when a storm comes. But we need them to be very selective. What industries do we invest into? That we can make a choice. And then the good thing of the story, because I try to be an optimist, when a storm comes, if change is happening fast now, you ain't seen nothing of how fast change is going to be when a storm comes. So if you're then equipped with very avant-gardist digital folks, and you know how to transform an asset from the old to the new, that change is going to go in rocket speed. So it's actually going to create tons of opportunity. But the bad thing is that we're all going to get whacked. The question is, are we going to be whacked once or twice? And that we can actually choose ourselves by selecting the industries we invest into.
Well, I forget who said that, when the music's playing, we still have to dance, but maybe we're dancing closer and closer to the exit door. Or I think, as Cathrin, you said, it's like musical chairs with everybody sort of circling around the chairs in the middle. Threats and opportunities, what do you see as biggest threats, biggest opportunities at the moment?
I think there are some very significant threats, some of which are, as you rightly say, very obvious to identify in terms of, leverage levels and interest rates corresponding to that, valuations being so high, those sorts of challenges and the political, geopolitical uncertainties. And then there are some very sort of specific subsector threats as well, which I think we need to be very aware of. I think some of the things that we're looking to do is also thematically look at some of those subsectors that actually will continue to actually have strong kind of underlying growth opportunities through a cycle, where if you have the right leadership and adaptation around it and you have a structure on your balance sheet that actually can survive that, you can actually hold it through that period and sometimes find additional opportunities to consolidate on during that period too. But certainly we're going to go into a period of greater uncertainty. I think specifically right now, I think one of the areas that I look at very carefully is that for a long time, US healthcare has been the place to be because of the egregious sort of pricing, the attractiveness in terms of margins in that business and such too. I think for the first time in a long time, actually it's quite attractive to be outside of the US from a healthcare standpoint because you've got greater certainty and visibility, which from a PE standpoint is much better. From a venture standpoint, probably not so, but I think from a PE standpoint, you've actually got less volatility and greater predictability, I think on the whole, and that diversification across country that you don't currently have in the US market.
So maybe a safe harbour in the storm. Who knows? Gabriel, your thoughts, biggest threats, biggest opportunities?
I thought threat and opportunity was supposed to be single-word answers. Listen, I think on threats, obviously we worry about the valuation environment. Obviously we worry about the amount of competition that's come through into our industry because of all the capital raised. So those things. I think what actually I worry most about for our industry is a lot of the investors have never seen a downturn. They have been investing into up markets continuously, adding leverage to that, and so they think they're invincible. And so I think one of the things we all need to worry about is how are we going to react as an industry when the downturn comes, if it comes. And then on opportunity, we see one at our fund level, which I think is really exciting, is private equity is still a massively underpenetrated product and source of funding in a lot of our markets, right? If we go to Southeast Asia, even China, Brazil, these are places where we're still educating companies on why it's great to take our type of capital, and we're very excited about that as a growth area. And then within our portfolio and within our more mature markets, digitization, I don't think there's a single business that's not going to see its market opportunity, P&L, product set change through some application of technology, and we're gearing up massively to take advantage of that.
Well, I suppose, we always think that everything revolves around private equity, but it's only 4 trillion. If you compare that with the public markets, it's only, at the most, maybe 1 or 1.5% of GDP. The US stock markets, I think, are at about 130% of GDP. So, let's put it in context a little bit. So I think that gives us some hope. Stephen, what are your views, opportunities and threats?
I think they're largely the same, meaning the same as what the other panelists have said, but also the opportunity and threat are really just flip sides of the same coin. So to me, obviously macroeconomic cyclicality, some of the technological innovation that that Gabriel invests in, it's not just the impact, but it's also the pace of the change. Yeah. And then I would say that globalism has obviously created a more difficult operating environment as a result of global competition and all the factors that one needs to consider. But that's the opportunity too. And I think, I kind of tell our guys, nobody has a perfect crystal ball, so find the 10 variables that you think are most likely to affect the success or failure of your outcomes, and then see how many of them you can actually control. The more you can control, or at least influence, the better your investment strategy will be over the long term. And that's kind of our philosophy, why we use operational improvement, because at least you can control some, pull on some of those levers. But I see, in essence, I see the same threats and opportunities as the others.
I was actually hoping for a bit more controversy on this panel, but I'm getting a sense of, cautious, I wouldn't say exactly optimism, but caution certainly coming through loud and clear, but there's still opportunities out there. So I think with that, we're out of time, unfortunately. I'd like to thank all the panelists, and I hope you all have a good rest of the conference. Thank you.